If silver disappeared tomorrow, solar panels would stop shipping, electronics would stall, and parts of the military supply chain would freeze, yet the entire silver market is worth less than a rounding error in U.S. deficit spending. China is buying. The U.S. is printing. Venezuela already lost its currency. Silver doesn't collapse systems. It exposes them. Silver is not treated like money anymore, but the global economy still behaves as if it were irreplaceable. In a single year, the world now consumes more than 900 million ounces of silver, while global mining production struggles to reach 820 to 850 million ounces, leaving a quiet deficit that keeps growing every year. This gap is not theoretical. It is real metal that does not exist. Unlike gold, which sits in vaults and central bank basements, silver is burned into the system. Roughly 60% of all silver demand is industrial, and once it enters a product, it rarely comes back. A modern smartphone contains fractions of an ounce. An electric vehicle uses 2 to 3 times more silver than a traditional gasoline car. A single utility-scale solar panel installation can consume millions of ounces in one project alone. Multiply that by China's solar expansion, America's energy transition, and global military manufacturing, and silver quietly disappears into wires, circuits, and coatings that will never be recycled at scale. This is why silver behaves differently from every other asset, because it is not hoarded, it is consumed. And consumption does not care about price forecasts or investor sentiment. It only cares about availability. What makes this more dangerous is that silver production is not designed to respond to demand. Less than 30% of silver comes from primary silver mines. The rest is extracted as a byproduct of copper, zinc, and lead mining. That means silver supply is controlled by the health of completely different industries. If copper demand slows, silver production drops, even if silver demand is exploding. Even if prices rise, new supply does not magically appear. It can take 10 to 20 years to bring a new mine online, and many of the richest silver deposits were already exhausted decades ago. At the same time, above-ground silver inventories are far smaller than most people realize. Estimates suggest that investable silver stockpiles are measured in months of industrial demand, not years. In dollar terms, the entire global silver market is tiny, worth less than what the U.S. government adds to its national debt in a few weeks. That imbalance matters, because while silver is priced like a minor commodity, it is embedded in trillion-dollar systems, global energy infrastructure, defense manufacturing, electronics, and transportation. The contradiction is growing sharper every year. Rising demand, fragile supply, shrinking inventories, and a price that still behaves as if silver were optional. This is not a market error. This is a structural stress that only becomes visible when something breaks. The silver problem becomes far more serious when you follow the money, because silver does not exist in isolation. It sits directly beneath currencies that are being stretched to their limits. The United States now carries more than $34 trillion in federal debt, adding roughly $1 trillion every 100 days, and the only mechanism keeping that system stable is confidence in the dollar. Nothing backs it in physical terms. At the same time, the global silver market is so small that at current prices, all the silver mined in an entire year is worth less than $25–30 billion, depending on price fluctuations. That number is insignificant when placed next to U.S. deficit spending, which can exceed $2 trillion in a single year. In other words, the world's most critical industrial metal trades in a market smaller than the budget overrun of a single government program. This imbalance is not sustainable, because it means silver can be repriced violently without absorbing much capital. It does not take mass adoption or public panic. It only takes a shift in perception. China understands this dynamic better than most. While Western markets focus on short-term price action, China has been executing long-term industrial planning. It is the world's largest manufacturer of solar panels, electronics, and electric vehicles, each of them silver-intensive. China consumes well over 1/5 of global silver supply, and that number continues to rise as it accelerates solar capacity additions measured in hundreds of gigawatts, not tens. At the same time, China has been quietly reducing exposure to U.S. dollar assets while increasing its strategic metal reserves. Beijing rarely announces accumulation in real time. When China speaks openly about stockpiles, it is usually years too late for markets to respond calmly. This matters because silver does not flow freely in a crisis. When industrial supply chains tighten, countries with inventory keep manufacturing. Countries without it shut lines down. Silver becomes a strategic bottleneck, not a tradable commodity. This is where the paper price begins to lose relevance. The majority of silver trading volume does not involve physical metal at all. It is contracts, derivatives, and promises to deliver later. For every ounce of physical silver that exists, there are multiple claims layered on top of it. As long as trust holds, the system functions. But when currencies weaken and trade blocks fragment, access matters more than price. The moment silver is needed rather than traded, the market stops behaving smoothly. It moves in gaps. The dollar system assumes liquidity will always be there. Silver's supply structure says otherwise, and the longer deficits grow, the thinner that assumption becomes. To understand where this pressure leads, you have to look at what happens when currency trust actually breaks. Not in theory, but in real economies. Venezuela is not an outlier or a freak accident. It is a compressed version of what happens when money is created faster than confidence can absorb it. At its peak, Venezuela was sitting on vast natural resources, including some of the richest mineral zones in the Western Hemisphere. Yet by 2018, inflation officially crossed 1,000%, wiping out savings that had taken decades to build. Salaries became meaningless. Prices changed between morning and night. The believer did not slowly decline. It ceased to function. In that environment, paper wealth vanished, but tangible goods did not. Silver and gold did not make people rich, but they retained the one property that mattered most: recognition. A silver coin held purchasing power when a month's wages could not buy food. This is not because silver is magical, but because it does not depend on policy credibility. It does not need a central bank to defend it. What makes this relevant to the global system is scale. Venezuela collapsed quickly because its economy was narrow and politically isolated, but the mechanics were the same ones now operating worldwide. Deficits financed by expansion, promises layered on promises, and confidence treated as infinite. When currencies weaken, governments do not reach for silver to fix the problem. They reach for control. Capital restrictions, transaction limits, import bottlenecks, and price mandates appear first. That is when physical metals stop behaving like investments and start behaving like infrastructure. In Venezuela, access mattered more than price. People did not ask what silver was worth in believers. They asked whether the seller would accept it at all. The transition from price discovery to acceptance is the line markets never model correctly. This is the risk silver represents to the modern financial system. It sits quietly beneath currencies that assume uninterrupted trust. In stable periods, silver is dismissed as volatile and inefficient. In unstable periods, it becomes visible again, not because people suddenly love metals, but because systems under stress reveal what still functions without permission. The US dollar has not reached that point, and China is actively working to avoid it, but the global system is now running multiple deficits at once: fiscal deficits, trade deficits, energy deficits, and resource deficits. Silver intersects all of them. It is used in energy, electronics, defense, and medicine, while also carrying thousands of years of monetary memory. That dual role is what makes it dangerous. When confidence erodes, silver does not need to be chosen. It simply reappears. What separates the United States and China from countries like Venezuela is not immunity, but timing and control. And this is where silver becomes strategically uncomfortable. The US dollar still dominates global trade, but that dominance is increasingly maintained by scale rather than balance. America imports far more than it exports, runs chronic fiscal deficits, and finances them through debt markets that assume perpetual demand. At the same time, the United States is one of the world's largest consumers of silver, while producing a relatively small share of what it needs domestically. Most of the silver flowing into American industry comes from abroad, often from politically unstable regions or long, fragile supply chains. That creates a contradiction. The currency at the center of the system depends on a metal it does not control. In peacetime, this looks efficient. In stress, it looks exposed. China has drawn a different conclusion. Instead of relying on open markets and just-in-time delivery, it has spent decades integrating raw materials into national strategy. China is the world's largest buyer of industrial silver, not because it is speculating, but because it manufactures at scale: solar panels, batteries, electronics, telecommunications, and military hardware. Each of these sectors consumes silver in ways that cannot be easily substituted. Copper can sometimes be replaced. Silver often cannot. This is why China's energy transition matters so much. Solar expansion alone requires enormous volumes of silver, and China is installing capacity measured in hundreds of gigawatts year after year. Even small increases in silver intensity per unit translate into tens of millions of ounces of additional demand. China does not need silver prices to rise to benefit. It needs uninterrupted access, while others assume access will always exist. This divergence creates an asymmetry in a crisis. When supply tightens, China keeps building. When prices spike, China adjusts policy. When trade fractures, China redirects flows. The United States, by contrast, relies on markets to smooth shortages and on financial instruments to manage risk. But silver is not a financial product in practice. It is a physical input. You cannot hedge a missing shipment into existence. When nations begin prioritizing domestic production, stockpiling, or strategic reserves, silver stops moving freely. It does not matter what the paper price says if the metal cannot be delivered. This is the moment where silver's role shifts quietly but decisively, from commodity to constraint. And constraints do not announce themselves. They only reveal who planned ahead and who assumed stability would last. Venezuela's relevance to the silver story is not symbolic. It is mechanical, and the recent signals coming out of the country make that impossible to ignore. Over the past year, Venezuela has quietly moved further away from functional monetary sovereignty. The believer continues to lose value in real terms, dollarization has deepened across daily life, and trust in domestic financial instruments remains effectively broken. What matters is not the headline inflation number anymore, but behavior. When people stop saving in their own currency and start transacting in anything else, foreign cash, commodities, barter, the monetary system has already failed. This is the stage Venezuela has been in for years, and it is now normalized. In that environment, silver re-enters the economy not as an investment, but as a fallback unit of exchange, especially in informal trade and cross-border transactions. That reappearance is quiet, but it is durable. At the same time, Venezuela sits on vast, underdeveloped mineral resources, including silver-bearing regions that have remained largely untapped due to sanctions, infrastructure decay, and political risk. This creates a paradox with global consequences. On paper, the world is short silver. In reality, large deposits exist, but they are locked behind instability. When countries fracture financially, resources do not rush to market. They become stranded. Recent developments around sanctions enforcement, currency controls, and state-directed resource policy have only reinforced this pattern. Venezuela does not export silver efficiently because it cannot integrate into the global financial system smoothly. That is the lesson markets underestimate. Supply is not just about geology. It is about governance, trust, and access. The impact of Venezuela's continued instability extends beyond its borders because it demonstrates what happens when a resource-rich nation loses monetary credibility. Production falls, investment dries up, and output becomes unreliable. For silver, this matters because a significant portion of future supply growth is expected to come from politically complex regions: Latin America, parts of Africa, and Central Asia. If even a fraction of those regions follow Venezuela's path, projected silver supply simply does not arrive. Demand does not wait. Solar factories do not pause politely. Defense contracts do not renegotiate timelines. Shortages emerge quietly, then suddenly. Venezuela is not a warning about politics. It is a warning about fragility. It shows how quickly metals can move from abundant on paper to unavailable in reality, and why Silveradia's true risk is not price volatility, but absence. This is where all of the threads finally meet, and why silver is so uncomfortable for modern systems to talk about. The global economy is now running on simultaneous assumptions that cannot all remain true. That deficits can grow without consequence, that supply chains will always function, that strategic metals will always be available at market prices, and that confidence can be managed indefinitely through policy. Silver sits at the intersection of every one of those assumptions. It is essential to energy, defense, medicine, and technology, yet priced as if it were optional. It is consumed faster than it is replaced, mined slower than demand grows, and controlled by no single nation. The market for it is so small that a minor shift in behavior, not mass panic, not global collapse, can reprice it dramatically. That is what makes silver dangerous. It does not require belief. It only requires stress. The United States continues to expand debt at a pace measured in trillions. China continues to accumulate and build without signaling urgency. And countries like Venezuela show what happens when trust finally fails. None of these forces move on the same timeline, but they converge on the same vulnerability. Systems built on promises eventually collide with physical limits. Silver is one of those limits. When access tightens, paper contracts lose meaning. When inventories thin, price becomes secondary to delivery. And when confidence weakens, recognition returns to what functions without permission. Silver does not need to replace currencies to matter. It only needs to be scarce when it is needed most. The final risk is not that silver suddenly explodes in price. The real risk is that it stays quiet until it cannot be ignored. Markets are trained to respond to noise, not absence. But history shows that the most disruptive shifts happen when something essential is assumed to be abundant, right up until it isn't. Silver has played this role before, across empires, collapses, and transitions. It never announces the moment, it simply survives it. And by the time the world realizes silver mattered, the system that dismissed it is already adjusting to a new reality.